You're watching Finweek Money Matters now. On many fund managers' presentations, the line that we've comfortably beaten the benchmark over this certain period is a common one. But do investors understand what it is, how it works, why it's there, and how it's calculated? In this segment, we're looking at what's in a benchmark. Mark and Jessica are still with me at the desk. We've got Craig Gradidge, Financial Advisor at Gradidge-Mahura Investments, and then Bernard Sebopa, Financial Advisor at Old Mutual, here to talk benchmarks. Thanks for joining us today. Craig, let's get into, very quickly for us, just remind us what a benchmark is. I know it's a layman's question, but of course, it's an important one before we get into the technical details.
Yeah, so a benchmark would be that thing that the fund manager will measure himself against. So as a client, you want to choose a fund that has a benchmark that's related to your investment objective. So if the fund manager beats his benchmark, it means that you've achieved your objective. But a benchmark should essentially be something around which there is a great degree of certainty and you're able to measure it with a great degree of certainty. So
you've got an equity portfolio, it's a balanced portfolio.
Yeah.
How do you find the right benchmark?
Yeah, I think that's the tricky bit, is the right benchmark, because I suppose, you know, for the fund manager, he wants an easy benchmark because then he looks good. As a client, you want an appropriate benchmark. So you want something that if the benchmark is beaten or achieved, then your investment objectives have been achieved, and you know, ultimately that's why you're investing.
Bernard, current thinking right now in the industry around using appropriate benchmarks and what is fair to the client, because you know, if you've got a misalignment there, then is it really fair for the financial asset manager to brag about it?
Okay, well, basically, let me start by saying that most of the time you find that when it comes to collective investment schemes, ASISA would set the standards and the guidelines whereby this is the manner that they want asset managers out there to invest for clients out there. So you find that we've got categories of investments. You would have your domestic funds that would have minimums and maximums of certain allocations that they must have in the domestic. You'd have your worldwide funds, you'd have your global funds also. So in those categories, there's subcategories that would fall in there. You'd have your equities portfolios, you'd have your asset allocation portfolios, would be basically your flexible funds, diversified balanced funds and such. And then you'd also have your real estate, you'd have your fixed interest, which would involve your bonds and your money market. So in most of the time, you find that all these categories would have certain benchmarks that are set by the ASISA. There would be times when you have a certain category of funds. Let's say, for instance, your equities portfolios. You would have all the funds that are in equities in the market. They would use a benchmark of the average return of all those funds in there, and then you would measure yourself as a fund manager against that average. And then you'd have funds that are benchmarking themselves against inflation. You'd have funds benchmarking themselves against the bond index. So it's basically all about that. At the end of the day, you'll find that you can't always beat a benchmark. You'll find that sometimes you'll be below that, you'll be above that. So it is a measure of just making for you to find out how you have performed against the average sector as a whole. So
in the process of setting the benchmark, would you say it's a fair and transparent process? Are people happy with the way it's done?
Well, I'm not of the idea that it would be an asset management company based target or something like that. There is those ones that are set by the sector, and then you would have your performance target. So let's say, for instance, a bond fund would, the benchmark on it would be the all bond index that of all the bonds that are selling on the JSE, and then the company might have a performance target of that average plus 2% on top of that. So that would be a personal one, but the average one would be the one that is according to the sector or the category that the fund would fall into.
Yeah, I mean, there's a lot of jargon, I think, that comes around benchmarking. So I use the very, very simple example of being a Liverpool supporter, because I think this is kind of something a lot of people associate with. If you're a Liverpool supporter and you go and you ask them for the last 2 years, what will they tell you? They'll tell you that if they hadn't hit the post in X number of games, they would have won the league by doing this. And you go and you look at their trophy cabinet, and the trophy cabinet's empty. and I'm an Aston Villa supporter, so I don't get to comment too far on trophies. Long and short of it, though, they still regard themselves as a top-flight football club. But how do they judge that? They didn't win anything. They're basing it on the fact that they may or may not have hit goals, and they've ultimately got nothing to show for it. So then you say, well, what does that mean? Should somebody be incentivized for being almost there, which then becomes something that the financial advisors have to put to the asset managers, is at what point do you get remunerated for it? Because I think that the next issue is remuneration for the asset manager because they beat their benchmark. And I think, look, fees have come down quite significantly in the asset management space, but there's always interesting products like inflation plus funds. There are the hedge fund type environment where the guys are remunerated for beating benchmarks, and the further they beat it, the better they're remunerated, which then leads to the discussion of fees coming off. So I think that's one of the issues that you have in South Africa, is that we can pick a benchmark and we can kind of make it a constantly moving target. Then the marketing material gets chucked out and you have this line which shows you the benchmark. Then you have the fund which says it outperformed it by a country mile, and you say, well, there you go, it's an easy buy. And I think
these are great asset managers.
Great asset managers. And then this whole issue of skill versus luck. And I guess, I don't know, Craig, if I put it to you, are the right benchmarks being used for individual products, or does the financial advisor actually have to take responsibility for creating the benchmark for the portfolio rather than the individual fund?
Yeah, I think that's an important question, because we can talk about benchmarks and how they arrived at. The important thing is to understand, based on a benchmark, what kind of behavior that leads to on the fund manager's part. So if he's trying to beat his peers, chances are the fund's going to look like his peers. If he's trying to beat the index, chances are the fund's going to look like the index. That'll be the starting point for that fund. But then as a client, you've got to say, well, so what if he beats his index? Will it mean that I've met my objective? So a fund does -20 and the peers do -25. You've lost money.
Sure.
And your objective may be, to preserve capital. So the role of the advisor is to interrogate those benchmarks and to ensure that the overall portfolio is relevant.
At the very minimum, you want to preserve capital when you're investing money, and then you want wealth creation beyond that. And of course, when it comes to preserving capital, it's around managing risks as well. Yep. So how's that built into the issue and the discussion around benchmarks? And how's that built into, I suppose, because benchmarks are used also for remuneration, how do you build managing risk into incentivization?
Yeah, so as an advisor, you need to interrogate the benchmark to see that it's relevant for that fund. But you're not going to have one fund for the client. So you're going to build a portfolio, and in trying to establish what this client objectives are, so you will come up with a number. This client needs to do, say, 12% per annum, which is inflation plus 6. Now you're going to have a portfolio with 5 different funds. That overall portfolio needs to meet those benchmarks. But each portfolio will have a benchmark. So when you as an advisor are assessing whether the fund manager has delivered what he said he would do, you've got this yardstick against which you can measure the manager. But the important thing, I think, is, sometimes the behaviors that the benchmark creates can be, and I think the best way is to give an example. We invest in equity funds that pay high dividend yields, but only one of them has a benchmark linked to dividend yield. All the others have benchmarks which try to outperform each other or try to outperform the index. So there's a disconnect between what they say they're doing and what they're benchmarking themselves against. So what we've done is we've completely ignored the benchmark, and we now measure, when we assess them, we see how have they delivered dividends relative to the market. So because now the benchmark is no longer relevant in that exercise. So that's where the kind of advisor has a qualitative or quantitative overlay to apply in assessing a portfolio.
Is that becoming a trend where people are choosing to ignore the benchmark and use their own assessments and their own strategies?
I wouldn't say it's a trend, but I think your skilled advisors will look beyond that. So we look towards the mandate of the fund, and the benchmark does become relevant when they start charging performance fees based on the benchmark.
That's where the contentious issue comes into it.
Yeah.
One of the main contentious issues.
Exactly. So if they set that performance benchmark, so you can have a performance benchmark, a fee benchmark, and a risk benchmark. If that benchmark at which performance fees kick in is too easy, that fund's going to be very expensive and you're not going to meet your performance objective.
So Bernard, tell us about, do you think there needs to be more regulation around benchmarks and the appropriateness of benchmarks? Do you think funds need to come under greater scrutiny to look at the benchmarks they're using?
Well, my view of this is that in every exercise with a client, every portfolio plan, it's a personal thing. So you need to assess your client's situation, you need to find out of their investment horizon, assess their risk appetite, and then choose a fund appropriately that would suit their need. Because there's many benchmarks out there, so you can't really say I'm choosing to go with the benchmark of an inflation or a benchmark of the bonds. It's all about you deciding at the end of the day what will suit your client, and then based on the information that you've gathered together.
I'm saying, should unit trust, should collective investment instruments come under greater scrutiny in this area, and are they?
Well, I think there's enough regulation when it comes to this. ASISA is doing as much as they can to make sure, because they've just recently reclassified the funds to make sure that they are understandable to clients out there, or asset management houses. They need to now to make sure that a fund, they write the mandate of that fund, the objectives, all those things, and also the name of the fund itself must tell a client what this fund is really about and all those things. So a benchmark, it's not really an issue whereby now we can say that the industry is not being really regulated enough, but I think there's enough regulation in that space.
Craig, what are the global trends when it comes to benchmarks? Are we seeing certain countries starting to move away from benchmarks, or is there any recurring thread?
Yeah, I don't think you can move away from benchmarks because you've got to assess the manager and you've got to have something which to measure him against. I think it's more the appropriateness of benchmarks. I think one of the trends that you've seen over the last few years has been the move to more inflation plus benchmarks.
Okay.
So saying, when you invest, you want to outperform inflation at the minimum. So understanding this fund and where it invests, how far above inflation you should be able to achieve. And so you're seeing a lot more funds, and even the industry flows are flowing into funds that have less index-orientated benchmarks and more inflation plus type benchmarks.
But then how, with equities that go through cycles, we know, and they're long-term investments, inflation is it's hard to really weigh those two up together. And surely that if you're underperforming during a certain shorter period of time, that might be detrimental to the fund, where it forces people not to have that long-term horizon.
Yeah, I'm not so sure that that's about the benchmark. It's about the asset class, and equities and your other risky asset classes will from time to time behave and have these extreme movements, and that's irrespective of the benchmark. So but if you've got inflation in there, plus a certain amount, and it's underperforming that during that certain period. Yeah. Essentially, what happens is if you're going to charge aim to beat inflation plus 5%, they'll typically add a period to that. So they will say inflation plus 5% over rolling 3-year periods. Inflation plus 2% over rolling 1-year periods. So the higher the above inflation benchmark, the longer the period of which they want you to assess that. So which takes care of the short-termism that happens when you have a volatile kind of movement in the market, specifically negatively volatile, that short-term period is together with a longer-term period, and then you can assess it a lot better. Well, we'll have to leave